Hello everybody, this is AK. I'm back. So all of us like to think that we are investors, but the truth is, some of us are speculators, and we don't know that, and we think that we are investors. Right? When we invest in something, we want to be able to value that something. We are able to do some valuation exercise based on numbers, right? Which are reliable to some extent, right? When we speculate, we are really free to imagine whatever we want. We are free to imagine what prices might be in the future, right? So that's really speculation, is not investment, right? So I've said this about some stocks before, and one of the stocks that I talked about was Tesla, right? And of course, there are people who are not happy about what I said, and those people are usually the people who are invested in Tesla and they are usually fervent believers of Elon Musk. I read something which might be interesting to not just those people, but to anyone who's interested in the topic, and that is something from RBC Capital Market. And apparently they have a base case valuation for Tesla of just over $1 trillion US dollars, and that is roughly double of the company's current valuation, right? So they value Tesla at twice of what it is trading at today, right? Which is a very bullish valuation, right? And how did they arrive at this? Is they place a very high value or high future value of Tesla's robo-taxis business, right? And apparently out of this $1 trillion base case valuation for Tesla, only 6% of this relates to the manufacture and sale of electric vehicles, which Tesla is famous for. So basically, if we think of it another way, is saying that it's $1 trillion valuation for Tesla. Only 6% is actually based on what is being produced today. 6%, and more than 90% is based on what it thinks will be produced in the future. So this means we have to be very careful, right? When we invest in Tesla, at least when we size our positions, right? Don't be 100%, because if Tesla doesn't deliver on those robo-taxis or on AI, that kind of thing, then Tesla should be worth a lot less, which is what I've said before in past videos. So just a note of caution there, right? And it's just a good example of what speculation is, right? Let's hope Elon Musk delivers for people who believe in the company, for people who believe in Tesla. Okay, so then let's move on to valuation of the local banks, right? That is something we can have a firm grip on, and less speculation and more investment. Okay. People have asked me at what prices would I think of selling my investment in DBS, UOB, and OCBC, and I've said, well, my favorite holding period is forever, right? Borrowing from Uncle Buffett. But I've also said before that when Mr. Market was very euphoric, DBS, OCBC, and UOB traded at as high as 2 times book value, and if it ever happens again, that would be a good place to think of maybe trimming our positions. Right, if we have big investments in the banks, we could take some profit off the table. Another way of doing, of looking at the numbers of doing valuation is looking at what its peers, international peers, are trading at. So if we look at, for example, JP Morgan, of course, the largest bank in the US, they are trading at somewhere about 11 times PE. And then we look at Bank of America, it's like 10 point something times PE. So it's between 10 times to 11 times PE, let's say. So if you say that Singapore banks at 9 times PE, it's cheap compared to the US banks. Then of course, if we look at 11 times PE, maybe has 20% more to go before it hits what we might think of as fair valuation vis-a-vis the US banks, that JP Morgan and Bank of America. And then if it gets to that level, do we want to sell some? Well, 20% higher than where they are today, maybe. Yeah, if you want to take some profit off the table. Like one famous investor said before, it's never wrong to take some profit off the table, right? So it's entirely up to the individual, but we can use PE ratio to think of where a fair valuation might be for the local banks, that's for sure. But don't think that the local banks will ever trade at something like 15, 20 times PE ratio. I don't think so, because the banks have always traded at a lower PE compared to some other industries, because by some standards, banks are considered riskier investments because they have a high use of debt. Basically, they are taking money from depositors, savers, and lending the money to other people. So banks are always in debt. If you think of it that way, that's one way of reasoning why banks always have lower PE ratios compared to some of the in inverted commas growth industries, right? So anyway, if AK can talk to himself, so can you. Bye bye.